Welcome students. So in this part of the discussion in this class, we will talk about the next topic, and that next topic is the time value of money. Time value of money is a very interesting area, very useful area for the new ventures or for the new investments, for the new projects, which helps us to evaluate the worthwhileness of that investment that we are going to make into any venture or into any project. And we are going to misevaluate that if we invest a certain sum of money in the venture, then how much is going to be over the period of time, what's going to be the growth rate of our money and miss that investment which you are going to make in the venture, and what is going to be the final result of this investment, and the investment which we are going to make, the risk we are going to take, and all these things. So this is a very useful concept, and without discussing or talking anything about the time value of money, we cannot proceed further with our discussion on the project finance or the investment finance especially, and to know about the selection of the new ventures as well as the financing of those ventures. So since this course is on the project selection and finance, so for selecting a new venture also you have to make this kind of analysis, this kind of evaluation of the investment, and financing also is another important decision and consideration for the new investments. So which projects we have to finally select and how they have to be funded, and finally what is going to be the outcome of those investments or those ventures, that all we are going to know with the help of the time value of money. And it's a very important concept. It's going to help us that how this investment is going to respond back, or maybe is going to give us the return on the investment, or how much money we are going to get after making an investment of a certain sum. So as we know that we have the different ways of making investment, different avenues of making investment in the market. Simple investment avenue is the bank. And when you go to the bank, so you give your money to the bank and you feel safe. And without taking any kind of the risk, you are investing your money in the bank, and after a certain period of time, they give you some returns. Right. After some period of time, they give you some returns, and we feel very happy that I earned some interest on my investment in the bank. So first important question here is that when we make investment of our funds or we give our funds scarce resource, this finance or our investment or our surplus funds, when we give to the banks and when they return back to us after certain amount of time with the increased amount, do you feel that they are going to return you something more than what you gave to the bank while making the investment? Is it possible that they are returning more than the amount which you gave to the bank for making investment in the bank? No, they are not returning more than that. Just because of the time value of money, because the value of our money has decreased. So if they return, for example, you deposited 1000 rupee in the bank, and if they return you 1000 rupee back, so it means 1000 rupee of today and 1000 rupee after 1 year is not of the same value. So when they return you with the 10% of the interest, maybe against 1000 rupee you are investing in any bank, and after 1 year bank returns to you 1100 rupees. So maybe you feel good that your money has increased from 1000 to 1100 rupees, but actually it is almost the same. Or sometime if the inflation rate is very high, then the value of that 1100 may be lesser than the value of 1000 rupees in the current period. So our objective normally remains or should be that when you invest your money into any kind of the investment avenue, its value should increase, right? Its worth should increase, and if because of any reason, one or the other reason, if the value is not going to increase, if the worth is not going to increase, at least it should remain same. It should be preserved. It should remain same. It should be preserved, and for preserving that, we are paid or we are earning some interest on our investments, some return on our investment. And now the $1,000,000 question is how much return that has to be. How much return that has to be. Say, for example, when you are going to the bank, you are totally risk averse. You are not taking any kind of the risk. You wanted to be 100% safe. You want that if I am giving my 1000 rupees to the bank, because bank is a government entity, or even if it is a private sector bank, it is regulated by a very powerful and strong regulator, RBI. So my money can't go anywhere. Bank cannot siphon off my money cannot go anywhere, is going to stay with me, or maybe is going to remain safe, and at any point of time I want my money back, it will come back to me. My investment back, it will come back to me, right? So that's the one important reason you go to the bank, because you are totally risk averse. You don't want to take any kind of the risk. So you are totally risk averse. You don't want to go to the any risky avenues of investment. So you are going to the banks and banks are returning you your money with some increased value, and if the inflation rate remains under control or at least equal to the growth of your money from 1000 rupees to 1100 rupees, and for example the inflation is also moving in the same process, so ultimately you have not lost anything, and that 1100 rupees after a year are equal to 1000 rupee of the current period. So that is your objective is fulfilled because you wanted to preserve the value of the money. So under the time value of money we study that only, that because the value of the money is not same over the period of time. Means any rupee today is not worth a 1 rupee or maybe a 10 rupee or 100 rupee after a year. These two amounts are totally different. So certainly that 10 rupee or 100 rupee or 1 rupee would be much lesser as compared to this its value in the current period after 1 year. So under time value of money we learn how to preserve the value of the money, how to grow with the value of the money, how to increase the worth of the investment. And here is a one important reason to understand the concept of the time value of money, because you are going to make your investment into the business. You are going to have your own investment, say option you are creating, and your surplus investment, your own funds are going to be invested into the venture. That venture which you are going to create, you are going to own and you are going to grow with. So because you are not satisfied with the rate of return you are being given by the banks or other investment avenues, even you are not satisfied with the other say markets, maybe the bond market you are not happy with the returns available, or maybe with the say your even the stock market, if you could go to the stock market yourself and try to make investment and get returns on that. So ups and downs of the stock market are going to compel you to think about, should I give my money to the stock market, should I invest into the stocks of different companies and bear the risk? Means should somebody else manage my resources? So again the answer is no. So neither you want to give your money to the bank, nor you want to go to the very safer bond market, nor you want to go to the little riskier stock market but giving you good returns. You want to manage your resources yourself. That's why you have decided to take risk, set up a venture, make investment in that venture and grow with your investment. So it means you are ready to take risk, and when you take the risk in this kind of the ventures or maybe in any kind of the new businesses or new ventures, that risk is going to be the highest level of the risk. You are ready to take that risk. You are risk pro, you are not risk averse. You want to take risk, you want to make investment in the business, and you know that you are confident that you can grow with the business. You can maybe create a venture, set up a venture, you can invest your funds, get the funds from the external sources also, make investment, manage that investment and get the rate of return at a rate which is the highest one as compared to the bank rate or the bond market or the stock market. So that will happen when you create the venture. When you create a venture, you take the highest amount of the risk. When you take the high amount of the risk, you deserve the highest amount of the return. And with the concept of the time value of money, we are going to measure that how much investment I am going to make in this current time and how much it is going to grow over a period of time, right. So this analysis is very, very important analysis. You should make this analysis because there is a kind of a, you call it as a technical thing, which we call it as a cash outflow and cash inflow. So when you make investment of your funds into the business or into the venture, maybe your own funds as an entrepreneur or the borrowed funds, venture capitalist funds or maybe the institutional financing or any other kind of the external sources of the funds you are going to get from, total investment is going to be called as an outflow from your side into the business. And then when you go for the operations or you move with the operations of the business, so after constructing the project, after completing the construction period, maybe the first year or the current period, then the production will start, operations of the business will start. So in the first year you will have some returns, second year you will have some say results or some maybe returns coming, then third, fourth, something like that, as we saw in case of the multi-year projections. So in the construction period you will build the project. In the first year you will start the operations, so you will go for production or generation of the services, and then you will sell those say products or services in the markets. You will have the sales. From the sales you subtract the cost of goods sold and all other direct and indirect expenses, and you will end up with the profit or loss in the first year, or maybe same profit or loss in the second year and profit in the third, fourth and something like that. So maybe we have the two streams of the cash flows. One is when we made investment of the cash flow in the business, that is called as a cash outflow, right? Into that project, when we are making investment, that is called as a cash outflow. Now, similarly, when you are making investment in the bank, that's a cash outflow from your side. When this bank is returning money back to you, 1000 plus 100 rupees as interest, so that's an inflow to you. So outflow was 1000 rupee, which is equal to 1000 rupee because it is in the current time. And after a year, when you are getting an inflow of the 1100 rupees, now you have to measure that whether that 1100 rupees you received after 1 year is equal to the 1000 rupees of the current time or not. And your objective is that the value of money should be preserved, at least if not grown up with, it should be preserved. So you will try to there is one outflow, 1000 rupee was the outflow, 1100 rupees inflow. Now you will compare the outflow with the inflow, inflow with the outflow, and because the outflow is in the current period, that is equal to 1000 rupees. When inflow is coming back to us, that is after 1 year, after 12 months. So though it is 1100 rupees, but we have to check with the process of the time value of money whether this 1100 rupees is equal to 1000 rupees of 1 year back or not. And if it is not equal to, it means your money's value has decreased. Maybe you have received 1100 rupees from the bank against 1000 rupees given, but still because of the high inflation rate in the market, your money's value has increased. It may be equal to 990 rupees, it can be equal to the 950 rupees of the current time. So in that case, your objective is not met. Even if it is equal, 1000 rupee and 1100 rupees after a year, if both these sums are even equal, right, still it is not your objective because you want to maximize the value of your investment. And maximization you feel is neither possible in the banks, nor it is possible in the bond market, nor it is possible in the stock market. It is only possible if you go for your own venture and you make investment into your own enterprise, own venture, own startup, or maybe by the existing firms into the new projects of the expansion, diversification and growth. So everywhere we use this time value of money, whether it is a startup, whether it is a existing firm, or whether it is any other kind of the investment we are going to make in the market, concept of the time value of money is very, very important. So you have to measure it, that at least my investment, if not growing, should remain safe. The value of my investment should remain safe. If it start deteriorating because of the high inflation rate, then we have to be very careful and we have to think twice or thrice whether we should continue making investment in the business or not. Or we have to look for the alternatives, or we have to do something so that our value of our inflows as against the outflows goes up or increases. So in this process, we will discuss in detail for the subsequent number of classes now the detailed concept of the time value of money, which will, as a student of the project finance, and even for selecting the new investment options or the new project proposals, you have to consider this very carefully. And as an entrepreneur, you have to learn it. As an, maybe you call it as a owner of a startup, you should be very clear about with the concept of the time value of money, so that you can understand that the objective which you wanted to achieve of increase of the inflows against the outflows, or maybe maximization of the return on the investment which you are making into your venture, or the maximization of the value of your business or your firm, whether that objective has been achieved or not. So time value of money will be used everywhere, every time, and for every purpose. So here are the important things why we are going to talk about this, your time value of money, and we have important things to discuss here. What we are going to discuss under this concept, we are going to talk about is why time value of money. We are going to talk about is the future value of a single amount, then future value of an annuity, present value of a single amount, and present value of an annuity. So there are two concepts. One concept is a concept of compounding, and another concept is a concept of the discounting. Compounding is basically, we talk about is that if we invest certain amount today in any avenue of investment, how much it is going to be over a period of time. And there, because compounding plays a role. Compounding plays a role. Compounding means you are not getting the simple interest, rather you are getting a compound interest. So when you keep on not withdrawing the interest on the regular intervals, but you allow the interest to be added back into the initial investment, so that investment plus interest, investment plus interest over the period of time, due to the process of compounding, when you keep on adding, the total amount of the money keeps on growing, and if the inflation rate is under control, so we end up in a situation where we get big money as a inflow as against the outflow, certain amount of the outflow, and the difference between the inflow and outflow remains bigger, and we achieve the objective of the maximization of our wealth. In case of the say discounting is we have to compare the present investment which we are going to make in the current period against the cash inflows which are going to come to us over the subsequent future years or the future periods. For example, the foreseeable life of a new venture is 10 years, and currently construction period is the current year, and that in the current year we are going to make an investment of 1 million rupees, and in the next say 10 years is going to give you maybe total 20-25 lakhs, 2.5 millions back by way of the annual cash inflows. So you have to visualize that amount, how much is going to come back to me in the first year, second year, third year, fourth year, something like that in the 10 years. And then you have to discount that amount because you want to compare the value of cash inflows in the subsequent years against the value of cash outflow in the current period. So you will discount that, and you would try to find out that sum total of discounted value of all the cash inflows, is it equal to the value of the present value of the cash outflow or not. And decision criteria is that the difference between the present value of cash outflows and discounted value of the future cash inflows, sum of all those cash flows, the discounted value of the all future cash flows, sum of those cash flows must be at least, means the difference should be 0. If the difference is positive, more than 0, it's very good thing because your inflows are much more as against the outflows. So it means what you invested in the business, the total return over the 10 years period of time is quite significant and quite high, is quite good. But if it is reverse, that you invested 1 million rupees and the present value, discounted value of all the 10 years of the cash inflows is somewhere, you call it as the 9 lakhs. It means we have lost money in the business, we have not made money in the business. Maybe the absolute value is more, but the discounted value is less. So we have to discount it against a certain discount rate, and that discount rate is basically called as the weighted average cost of capital, and with that cost of capital we discount the cash inflows coming in the future years, in the subsequent years, and when you sum up all those discounted cash flows, the summed up value of those future cash flows must be at least equal to the present value of the cash outflows. If it is 0, yes, you can accept that this investment is worth making, but if it is negative, don't go for that investment. But if it is positive, yes, sure, you go for making that investment, and rather you can think of making more investment into that venture or that project because the net result is positive and it's going to give you more returns, even discounted returns, more than the present value of the total cash outflows. So this all we are going to discuss in the subsequent discussion or in the subsequent slides. So first question is, why time value of money? Why we calculate the time value of money and why it is required, why it is important for us. You read this line, a rupee today is more valuable than a rupee year hence. Right, a bird in hand is better than 2 in the bushes. Right, a bird in hand is better than 2 in the bushes. Same is the case here, a rupee in a hand today is more valuable as compared to a rupee you are going to earn after a year from now. So our objective is, you are giving that investment of 1 million today, and that 1 million of today is 1 million of equal amount, and if you go with that 1 million rupees, you can buy a certain amount of goods and services from the market. But can you buy same amount of the goods and services with the same amount of money of 1 million after 12 months? If you can buy the same amount of the goods and services with the same amount of money, then there is no decrease in the value of your money or your investment or your surplus funds. But it is not going to happen because there is inflation in the market. So after a year, if you go with the same amount of money, the amount of the goods and services you are going to buy will be certainly lesser than how much you buy it today. So why time value of money? Means a rupee today is more valuable than a rupee a year hence. A bird in hand is more valuable than 2 in the bushes. Something is going to come to you in future, and something is already with you. So, is that coming to you in future is equal to what you have in your hand today? That is a minimum, that is a minimum decision making criteria, that your investment value should not go down, it should not decrease, rather it should remain safe or preserved, or it should grow. So, why we go for the time value of money? Because preference for the current consumption over the future consumption. If you consume that 1 million rupees, are you going to get the same amount of goods and services after a year also? The amount of goods and services you are going to have today? This is one. Second thing, productivity of the capital. Productivity of the capital decreases over a period of time, again largely because of the inflation factor. You cannot buy the same inputs even in your project, in your venture. The amount of the raw material which you can buy for 10 lakh rupees, 1 million today, you want to manufacture the mustard oil. The mustard seed you can buy for 1 million today, you are not going to buy the same amount of the mustard seed with the same amount of 1 million after 12 months. So, productivity of your capital will go down. Talk about the labor. The labor hours which you are going to get in the current period, in the current year for 10 lakh rupees or 1 lakh rupees, same amount of the labor year or labor amount or labor hours you are not going to get in a period after 12 months, because there is an annual increase in the labor. And third important thing is the inflation. So, even the first 2 points are largely because of inflation, but the third important point, directly we are talking about the inflation, and because of the inflation the value of money goes down, and that to preserve the value of the money, we always have to calculate that how much is our outflow, how much is our inflow, and are we able to, by making investment of our scarce resources, our scarce money into any venture, into any project, are we going to preserve that the value of my money or not? And my objective is not mispreserving the value of the money, rather to grow with it. That is why I am into business. I am going to take a huge risk. When I am going to set up a venture, when I am going to set up a startup, I am going to set up a venture, I am going to take huge risk. When I am going to take a huge risk, I deserve the good amount of the returns, and for that purpose, the value of discounted value for all the future cash inflows must be much more as compared to the value of the total amount of the cash outflow which you are going to make in the current period. So, on the one side you keep the outflow means the investment, on the other side you calculate all the inflows from the projected financial statements. Now, you understand the importance of the projected financial statements, because if you have not prepared the projected financial statements, you cannot compare the value of the outflows and inflows. So, you have already prepared the projected financial statements for the next 10 years. You know that how much cash inflow is going to be there with you for the next 10 years. So, you can easily discount that against the cost of capital, weighted average cost of capital, which is called as R, discount rate, and you can find it that what is the state of my outflow, value of outflow and inflow, and what is the difference. Is the difference positive? Is the difference 0, or is the difference negative? Minimum decision criteria has to be 0. If it is 0, fine, I will grow with it. But if it is negative, we have to think about, and maybe we have to look for the alternative, and we have to finally we have to not to go for this kind of the venture. So, inflation plays a very important role. Largely because of the inflation, we have to go for the calculation of the time value of money. So, it is clearly mentioned here that many investment projects involve cash flows occurring at different points of time. For evaluating such cash flows, an explicit consideration of the time value of money is required. Your investment is in the current period, so that is equal to its value. But your inflows, your returns from that investments are coming to you over the next 10 years. So, first inflow coming after 12 months has some value, but next inflow coming after another 12 months has a value lesser than the inflow value of the coming after 12 months. The next one, which is coming after 24 months, that has a lesser value. For example, the total inflow is same, 10,000 in the first year and 10,000 in the second operating year. So, that 10,000 which is coming back to us as an inflow after 12 months is not same as the second inflow coming after the 24 months of the same amount of the 10,000 rupees. That second inflow would be lesser in the value as compared to the first inflow of the 10,000. So, to make that inflow for the second year equal to the first years of the 10,000 rupees, you have to earn the cash flow more than 10,000 rupees. So if it is going to give you a means say kind of a similar cash inflows, annuity kind of the cash inflows, in that case we have to be very careful in evaluating the inflows and outflows and calculating the discounted value for these inflows and outflows. So we have to be very careful while calculating the time value of the money. So because we want to have the same value of the money or grow with our investment, the productivity of the capital decreases over a period of time because of inflation. So there is a need for having the something which we call it as the time value of money, and calculation and understanding the concept of the time value of money as an entrepreneur is very, very important for us. Then we talk about certain next things, and the next thing important in this component is the two timelines we are going to discuss here. So these two timelines are going to talk about something that if you see the cash flows coming to us. So we have the different periods here, right? We have the different periods here, and since these all cash flows, this is this 10,000, this 10,000, this 10,000, this 10th, all the 5 cash inflows are not in negative. So it means they are inflows, not outflows. So we are seeing here that in the zero period, in this part A structure, in the zero period there is no cash inflow, whereas in the part B there is an inflow in the zero period also, right? So it simply is going to indicate us the timing of the inflows. This first structure indicates that this is going to talk about the, say, the structure, the timeline is going to indicate about the period of cash inflows, and second structure is talking to you, is communicating to us is the point of the cash flows, point of the occurrence of the cash flow. So period of the cash flow and point of the cash flow. So it means because this is coming to you at the end of first year, 0 to 1 means this is the end of the first year. So cash flow is occurring to you at the period of time and maybe after the expiry of certain period, and this period is of the period of 12 months or a year. So at the end of every period of 12 months we are getting some inflows. So this is called as the concept of the period of time. Second picture is telling you about the concept of the point of time. So hardly there are any kind of investment options where the cash flows occur to you in the zero period at the point of time. Largely in all the investment options, in all the investment proposals, cash inflows occur to you only at the end of the period. So we will, for our subsequent discussion, we will follow the upper concept, upper structure, and the period of cash flows means occurrence, period of the occurrence of the cash flows. And for our discussion, our calculations, we will assume that cash flow will come to us at the end of the period, means we are going to follow the concept of the period of cash flows, not of the point of the cash flows. So we are going to talk about that cash flows are going to occur at the end of certain period, and at the end of every year, every period of 12 months, we are going to get the cash inflows. And for our discussion, we will follow the upper structure, part A, not the part B. So because normally cash flows occur, cash inflows occur to you at the end of the period. So at the end of the first year we are getting 10,000, at the end of the second year we are getting 10,000, at the end of third year we are getting 10,000, at the end of the fourth year we are getting 10,000, at the end of the fifth year we are getting say 10,000, and there could be some outflow also which is not given here, and the discount rate or the cost of capital is 12%. So we have to discount this 10,000, 10,000, 10,000, all 5 years 10,000 against that 12% discount rate, and finally we will have to find out the value of this 10,000 after 1 year is how much, must be less than 10,000. This 10,000 after 2 years must be less than 10,000, significantly less than 10,000, even lesser than the first 10,000. This third year lesser than the second and first years of the 10,000s. So like that, we'll have to calculate the total value of the money from these 50,000 rupees which are earned or received as inflows over the 5 periods, over the end of the 5 periods. And finally, we will be discounting these cash flows at the rate of 12% and comparing these inflows with the total outflow. So we will see that how much is the value of outflow, how much is the value of inflow, and finally how much is going to be the end result. So in this case, we will follow for our subsequent discussions here the timelines which are kind of a period of time of cash flows, not of the point of times of occurring of the cash flows. Now we will use certain notations also. So these notations, because in the subsequent discussions we will have some formulas. So every time we will not be explaining the formulas, that what do we mean by different notations. So let's have a look at these notations. So PV means present value, FB, N is the future value for N number of years. right? CT is the cash flow occurring at the end of the year T. A is a stream of constant periodic cash flows. It means A is basically the cash flow coming to us over the different periods of time. R is basically the interest rate or discount rate. G is the expected growth rate in the cash flows, and N is the number of periods over which the cash flows will occur. So, we will be repeatedly using these notations in the different formulas and different models. So, you should understand what do we mean by PV, F, B, N, CT, A, R, G or N. So, once for all we have given in this slide, and then we will be going to the subsequent slides, subsequent discussions, and we will be discussing all this to know about the overall concept of the time value of money. So, we will be talking in the subsequent discussions about the future value of a single amount, future value of an annuity, then the concept of the compounding and discounting, and all these related concepts. We will even learn about how to calculate the loan repayment schedule, how to calculate the EMI, what do we mean by say simple rate of interest, what do we mean by the compound rate of interest, how to go for the compounding, how to go for the multiple periods of compounding, what does it mean and how our money grows as a magic of compounding, as a result of compounding, how it gives the wings to our money, how our money grows and how the compounding plays a very important role. All these things will be the subject of discussion for the subsequent classes or subsequent discussions, subsequent lectures, and you will understand clearly at the end of the completion of on the completion of the discussion on the time value of money, you would be very clear, thoroughly clear about that what is this concept of time value of money, how it is investment in the say new investment proposals or new investment options, and why should an entrepreneur should clearly understand this concept of the time value of money before making any investment into the venture. So, with this we will stop here only, and the subsequent discussion on the time value of money we will have in the next class. Till then, thank you very much.